One of the questions I get the most on my YouTube channel is, what firm should I invest with? If you're telling me to maybe go to a less expensive investment position, i.e. fire my guy who's charging me 1%, where should I go? So let's talk about in this video the big three, Fidelity, Schwab, and Vanguard, and we'll go over the pros and cons of each, all right? And we'll go into that here at the Heritage Wealth Planning YouTube channel, so subscribe! There's a little red triangle down there. Subscribe, my friends. I'm almost at 10,000, so if you're not quite there, hit subscribe. And then, of course, comment, thumbs up, the whole thing. Share my videos too. If you find this informative for yourself, maybe your friends and families might find it informative too. Maybe your enemies might find it informative. So share the video. All right, so let's dive right into this. So first and foremost, let's go over Schwab. Now I've worked at, of the big three, I've worked at two. I worked at Schwab and Vanguard back when I started my career, 97, 98, 99, and a bit into 2000, 90, something like that. But back in the 90s and into the beginning of 2000. Never worked at Fidelity. I know a lot of people work at all three of these firms, though, my friends. Lots of people. People go from USA to Fidelity, USA to Schwab, Schwab to Vanguard. I mean, it's like swapping underwear. So people go from firm to firm to firm. Grass is not always greener. There's a lot of similarities between the firms, but there's some differences too. And the first one comes with the way they're owned. Who owns the three firms? Well, let's start with Schwab. Schwab is owned by the shareholders. So they have Chuck Schwab. Ask Chuck. Charles Schwab is a wonderful human being. I've never met the guy, but he's done wonders for the consumer in terms of discount brokerage. That's a fact. Schwab has literally reinvigorated the business that was just dying on the vine back in the late 70s because the cost of buy and sell stocks was so doggone high. Only rich people could do it. When Jimmy Carter and Ted Kennedy, I mean, I'm telling you, the irony of it all, that when they deregulated lots of industries back in the late 70s, one of the industries was the discount brokerage, and Schwab was right there at the cusp and was able to take advantage of that and offer wonderful, wonderful products. So just regular Joe Schmoes like you and I could buy and sell stocks without remortgaging the house. And so Chuck Schwab owned the firm. But like with any capitalistic enterprise, when you want to expand, you have to raise money. You can do that by issuing debt. Very few lenders are going to issue debt to just some guy running an investment firm in his basement. So you go public, initial public offering. You sell shares, you sell your company, portion of it, if not the bulk of it, most of the time will be the bulk, to the general investing public. And that's what an IPO is, an initial public offering. And so Schwab sold the company to the public. And now I guarantee he still retains a significant number of shares in there, but he does not call the shots. The people who call the shots are the shareholders. Now, what happens in a shareholder capital company, like a publicly traded company, is that the shareholders, in theory, get together and they vote on a board of directors, almost like a representative democracy or republicanism. And the board of directors, basically follows the mandates of the shareholders and will hire and fire the CEO, and that's how it's supposed to work. So Schwab, give you an example. When I was there, a guy named Dave Potrock was a CEO. And he was there for a couple years. Actually, somewhat of a revolutionary guy. The guy always kind of rubbed me wrong. I didn't like his personality. I never met him either. But he had written a book called Clicks and Mortar or something like that, or Clicks and Bricks. I can't remember what it was called. That was actually pretty in front of the times. Now, that was during the .com thing, and I remember his Potrock was saying Schwab doesn't want to be known as an investment company. He wants to be known as a technology company who does investments. Everyone was going in that mode back then. We want to be known as a technology company. Even like USA and whatnot. I was like, oh, killing me. USA does that now too. But anyway, it's one of those things like, gee, that's so just boilerplate, cliched, and it cost him his job. And the reason was because the shareholders, Schwab stock got crushed. Shareholders got together, and again, the people who represent the shareholders, the board of directors, they fired Potrock, and I think they brought Chuck back then to revamp the organization. And he's done a wonderful job, no other way around that. But he does not own the company. The shareholders own the company. Now, with that said, hundreds of millions of shares outstanding. I have literally no idea, but millions and millions outstanding. So what does that mean? Does your 500 shares and my 500 shares buy you any? Do you get a seat at the table? No. who the board of directors are hedge funds, big shareholders. They literally can buy their way onto the board of directors and make policy. There's no getting around that. So say you have 12 board of directors. If you have, I don't know, 10% ownership stake in Schwab, you are going to be on the board of directors because you have enough votes that you can vote yourself on the board of directors. And that absolutely nothing wrong with that. That's how it works. So now let's just say Chuck Schwab starts smoking dope and acting like a crazy man, and you are on the board of directors and you only have 10% voting authority. Well, you're going to have to do some politicking to get the other people to get Schwab off the board of directors, which is what they had to do with Schwab, with Dave Pottruck. And so what happens is the shareholders are being represented theoretically by the board of directors. And again, the board of directors doesn't represent me. They represent their own interests. What they do is they get together and they say, Schwab, you're out of here. We're going to bring in old Josh Scanlon because we like him doing these videos in his basement. That's going to do good for us. But what do the shareholders care about? Do they care about Chuck Schwab? Do they care about old Josh doing videos in his basement? No, they care about the shareholders. All right, so they care about the stock price. They don't care about you, Mrs. Granny Smith, with your 100 shares or $50,000 retirement fund at Schwab. They don't. I mean, they'd love for you to do well, but they care about the shares. And so if I'm a hedge fund manager and I bought 10% of the company in which to get a seat on the board of directors, I could care less if Granny Smith does well in her stock trades that nets $4.95 a trade. I don't care. I care about the price per share and the price per share only. And if it's growing in earnings and dividends and profits, I care about nothing else. Thus, how do we grow in dividends, earnings, and profits? Well, you can see where this goes. It's not going to be by giving away stuff for free to Granny Smith with her $50,000 IRA. It's going to be by finding ways to charge you more, Granny Smith, with your $50,000 IRA. That's the drawback by shareholders. They got to maximize the profits. They don't do it necessarily on giving away you free stuff. And so that's the issue. Whenever you see a firm that says you can get this for free and that for free, there's a catch because they cannot give it away and maintain their jobs. What is it that they're giving away? Well, they're giving away something. It might be your data. It might be your opportunity for them to solicit you in the future. I don't know, but they're giving away something. And that's the one drawback about Schwab is that they have the resources to generate all kinds of capital inflow if they need to sell shares, maybe to borrow money to increase, to get cash coming in. But that could happen at the hurt of the shareholders, and the shareholders don't want to be hurt, and in particular the board of directors. They want to grow their money. Has nothing to do with your bottom line, Granny Smith. It has to do with their bottom line. All right, so let's look at Fidelity. Another huge company. They're owned by the Johnson family. I think it might be. Is that Woody Johnson who owns the Jets? I got Abby Johnson on my mind. I'm not sure if that. I think that might be his daughter. Johnson family worth well over $20 billion now. And so they own Fidelity. And so anytime Fidelity does business, and the money goes to them. That's what happens. And so it goes to the Johnson family bottom line, which means as long as the Johnson family's happy, then all is good. Whereas at Schwab, you might make Chuck Schwab happy, but if Joe Schmo, the hedge fund manager, isn't happy, you're going to have some heads being butted, and that's not good. Fidelity, all that matters is that the Johnson family's happy, and if they're happy, all is good. And what makes the Johnson family happy? Making money. I mean, that's all there is to it. I mean, they got $20 billion in net worth. They probably want $30 billion in net worth. How do they get that? By making Fidelity more profitable to them. Not more profitable to you, Mrs. Granny Smith, with your $50,000 IRA. And so again, if Fidelity is giving away free stuff, they're doing it in order to make your life cheap? No, they're doing it in order to be able to get profits from you someplace else. There's just no other way around that. Doesn't mean they're evil. It just that's what it is. They make money, they're happy. They don't make money, they're not happy. Giving away free stuff means they're not making money, they're not going to be happy. So there's no free stuff from these two places, none. Because inherently they have to make money or else they're not happy. They're not happy. People are getting fired. Offices are being closed. The current board, I don't even know if they have a board of directors, but whoever is a CEO or whoever's managing the accounts gets fired. John's family not happy, people lose jobs. People do not want to lose jobs because they're making big bank at these places. Board of directors isn't happy, people losing jobs. People don't want to lose jobs because they're making big bucks. So let's go to our third one, Vanguard. Who owns it? You, the investor. You own it. That's what makes Vanguard so revolutionary. It's a mutual company. It's owned by its shareholders, but the shareholders are not shareholders like this are literally the investors, the investing public who owns Vanguard, owns the firm. Now, with that said, you, Granny Johnson, and me combined, we don't have one crumb. They won't even let us within 6 miles of Vanguard's campus because they have, I don't know, trillions of dollars of assets. The trillions of dollars. But who are the biggest people in Vanguard? It's the hedge funds, it's the pension funds, it's the insurance companies. Why do those people invest in Vanguard, and why do they have such a voting, and what will their votes mean? It means they aren't trying to make profits from Vanguard from the share price going up. They're trying to make profits by keeping their fees low. So just using a hedge fund example, if he a 10% hedge fund owner and a 10% Vanguard owner, he's on this account because he wants the stock to go up. He's on here because he wants to keep his fees low. How does he keep his fees low? By being a Vanguard as an investor and mandating as an investor who owns the company, as do I, as do you, that we're going to keep the fees low. Why? Because that's how we make the most money. So an investor in Vanguard feels he makes the most money by keeping his fees low. An investor at Schwab feels he makes his most money by having the stock go up. Two completely different things, not mutually exclusive. They both can happen. But where a shareholder here, all he cares about is the stock price going up, a shareholder here, investor, who has heavy voting authority, cares about keeping the fees low because he has the most to lose by higher fees. And so that's what makes Vanguard so unique and so wonderful, is that it is literally owned by the investors, and the investors have an incentive to keep the fees low. That's all there is to it. Now, a couple drawbacks. Vanguard only has offices in Phoenix. That's where I started working. There was in Phoenix. It was in Scottsdale, and then they have one in Charlotte, North Carolina. Then Malvern, Pennsylvania. I don't think there's a fourth one in the United States. I don't think so. There might well be now. It's been a long time, but that's it. So if you want a face-to-face relationship, it's not going to happen at Vanguard. Just not. You're going to have to go to Fidelity, Schwab, because I think they each have over 300 offices scattered throughout the United States. I remember Schwab when I worked in Center City. This is how idiotic USAA's wealth management was. We had an office in Center City, Philadelphia. Significant real estate costs. We just rented it, but it's dumb. And I remember walking by the Schwab office every day, and Schwab is not USAA. So Schwab can have an office downtown. USA should never have an office downtown. Stupid. But I remember they have offices scattered throughout the United States, as does Fidelity. I think Schwab's more in the cities and Fidelity's more in the suburbs, like Fidelity, like the Woodlands. I remember driving through there many years ago and seeing a big Fidelity office there. And I don't recall seeing a Schwab one. But anyway, that's my impression. I don't know that to be true or not. But anyway, so if you want to see somebody at Schwab or Fidelity, you can go in the office. Now, the drawback about that is those guys have an incentive to get you to do things, i.e., Schwab and Fidelity both allow separately managed asset managers, SMAs, to get on their platform. That way their account people who you see in the office can solicit their business for you, or solicit you for their business. So essentially what happens is, old Josh has made $1 million. I go down there to Schwab. I say, hey, Schwab, I want to talk to somebody about my money. They say, here's Joe Schmo. So I'm talking to Joe Schmo. He says, well, we could do this, we could do that. This one I like right here, and this is an account that's managed by, I don't know, freaking Shark Tank firm, whatever it is. And Shark Tank firm is on their platform that the Schwab guy can basically recommend to me to invest my money with them. Well, how does Shark Tank firm get on that Schwab platform? Do you think Schwab opens it up to everybody? No, Shark Tank firm pays to play. There's just no other way around that. There's 1,000 million investment managers, and not that many are on the Schwab platform. Now, Schwab and it's Fidelity too. This is both Schwab and Fidelity. Schwab will say, we do our due diligence, we like their manager, blah, blah, blah. I absolutely get that. But Shark Tank firm, if they do their due diligence, they like the management, they like the performance. If Shark Tank firm isn't paying Schwab something, Shark Tank firm ain't getting on the platform. It's that simple. It's not going to happen. So you got to remember, it's pay to play, good or bad. On top of that, the guy that you're dealing with at Schwab has an incentive. I know this for a fact, my friends, to hopefully move you from the Schwab free accounts, the index funds, into their separately managed accounts. That's just a fact. The more they can direct traffic into those profit centers, i.e. separately managed accounts, fee-based accounts, the more they get paid. That's the same thing it was at USAA. There's no other way around that. And Fidelity is the same thing. I mean, that's the exact same thing. They are there to say, we can solicit our clients on behalf of these separately managed account firms, and we will get paid, and Schwab and Fidelity get paid as well. So that's what's happening when you have these free stuff. Both Fidelity and Schwab offer no-fee index fund accounts, which are wonderful. But again, they can't give away the store for free or else they will all be out of work. So what is that they're doing? They're buying your data in order to solicit you in the future. I got no problem with that, none in the least. So you will be called at some point, presumably, and say, hey, Granny Jones, I see you just dumped $100,000 into this account, money market account. Would you ever be interested in talking to one of our investment guys? Yeah, I would be. Okay, so now you go down there to Center City office, you're talking to a guy, investment guy, and he says, we have this separately managed account called Shark Tank Fund that might be pretty good for you. And you say, that sounds pretty good. Now, hopefully he discloses the fees, and Schwab and Fidelity, they're going to do that. But at the end of the day, now they get a kickback. And that's not evil, it's not wrong, as long as it discloses completely legit. But is that beneficial to you relative to just going to a Vanguard fund, Wellington, for instance, that only charges you 25 basis points? Hard to say. I don't think so, but I can make an argument for that, sure. I mean, you can look at some American funds. They smoked the S&P 500 and Wellington for 40 years. Does that make it? I have no idea. But there are times where that might work. The vast majority of the time, I'd say don't do that. Just go to Vanguard, be done with it. But if you need a face-to-face person, you want someone to actively manage your accounts, Schwab and Fidelity can offer that to you. Without question, they can. Without question, Vanguard just simply cannot. And so that's a drawback. The reason is Vanguard's cheaper, well, because they don't have all the real estate. They don't have Center City real estate, which is what made me so mad about USAA. USAA is a mutual company owned by its policyholders. Why in heaven's name would they put a big fancy schmancy building on the Center City on the 46th floor of One Liberty? That's stupid. You don't see that in Vanguard. I'm telling you right now. And Vanguard and USA are aligned. Certainly not Schwab and USA. So that's dumb. And Fidelity and Schwab in this regard are the same thing in terms of their separately managed accounts, their ability to get your info and solicit you for other things. It's absolutely not evil. It's absolutely acceptable. Just know what you're getting when you're going in. Nothing in this world is free, my friends. Nothing. Even Vanguard charges you. I mean, that's a fact. They still charge you 25 basis points for Wellington or whatever it is, for sure. One thing we did not talk about here is TIAA-CREF. They have a similar ownership structure, kind of Vanguard, but they have a pretty significant incentive program for their advisors to put you in their managed accounts as well. And I've heard many horror stories from advisors who used to work at TIAA-CREF, and that's just not, just be careful. That's all I got to say about that. Just experience from many different words of mouth leads me to believe that the big three, Vanguard, Fidelity, and Schwab, if you need an investment firm, the big three are absolutely way to go for sure. I would say USAA, but they just sold off their investment management company, IMCO, and now they're going into I don't know what's going to happen with USAA. I mean, they sold off their investment management firm, and all their mutual funds are no longer owned by USAA. And I don't know what that means. So as we sit here today, these are the big three. I have no problems with any of them, none whatsoever. My preference is Vanguard, simply because you know what you're getting, and you're getting the least expenses, the least glitter, the least glamour, which means the least expense. And over time, expenses are the number one way to determine your performance. Really, everything else is secondary to that. Luck, essentially, would be secondary. And, I don't want you to speculate. I want you to invest. But if you're to choose Schwab or Fidelity, I wouldn't blame you. I got no problem with it. Just know what you're paying for. All right, guys. Well, as always, you like what you see here, subscribe down below, thumbs up, comments, share the video, and we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks now.